All right, the recording for today is on. For those of you that were just in the waiting room, I have admitted you, but we all are going to deal with some changes that the university instituted on us as of last night. I assume that you would have gotten the memo, but going forward, because of Zoom bombing and other problems, they have changed the security for all university Zoom meetings by default. So going forward, you have to register for a Zoom meeting, and you have to log in with the authenticated UMD account through ELMS. Otherwise, you're going to be locked out of the Zoom meetings, right? So those of you that were in the waiting room today, probably you weren't logging in with your ELMS account through the Zoom portal. So essentially, you're going to have to start registering and again, going through that using your umd.edu email, not another email. Otherwise, it won't let you in. And if you're not in the meeting, then for attendance purposes, it won't have any record that you were here. So, and they're strongly encouraging the faculty not to let people in, even if we recognize your name, because I guess Zoom bombing has been a problem on campus. Now, we haven't had that in this class. And right now I let in the 18 people or so that, had trouble that were stuck in the waiting room, but just going forward, that was the process. We're all going to have to learn how to do it for the rest of the semester on campus. So just a word to the wise on that one. The other thing I wanted to start today is to talk about two important logistics changes. On Wednesday, Bloomberg is going to be here all day for all sections. Again, the people that are going to be presenting and doing advanced Bloomberg training basically are the education team that does recruiting on campus. So twofold. One, it's a chance to learn about Bloomberg advanced training. And two, it's a chance to connect with potential recruiters if you're interested in an internship at Bloomberg and or a full-time position. UMD has become a pretty good feeder school. We've become a pretty good feeder class. A lot of alum from this class work at Bloomberg now. And so it's just a good opportunity. They're very excited to actually have access to this class, particularly this year, because they know recruiting is more difficult. And so it's kind of win-win for everybody. So it's not a recruiting event per se, but you are meeting the people that are going to be doing the training that are looking for full-time and again, intern positions for next year. So just a very important opportunity to take advantage of, make some connections as part of our next class. So that will be all day Wednesday, right? Monday, which I shifted from what was originally due on Wednesday, is going to be group case 1, okay? And it's basically going to be an EIC project on CVS health, right? So unlike homework 3, where you had to write an individual paper, group case 1 on the EIC will be a 10-minute PowerPoint presentation, basically doing an EIC on CVS. You guys are probably familiar with CVS. You probably go to their stores, but in any event, it'll be on CVS health, and that's going to be a 10-minute presentation. It's a group presentation. So you can decide how many members of your group you want to be part of that presentation. You're all going to be graded equally. So even if you don't present, you still get the group grade. Now you should all participate in the creation of that PowerPoint because there will be a peer review after the group project, so that if anybody isn't fully participating, then your peer members could mention that, your group score could be adjusted accordingly. But essentially, you're going to do verbally what you would have done in writing on the previous 2 assignments. All right, so you'll cover the EIC, you'll cover it in PowerPoint, you'll basically embed screenshots of the beta and the industry spreads, and any other data that you need needs to be in that PowerPoint file, and then you'll present the information to me verbally, and I will grade you based on what you say. There's no write-up other than the PowerPoint that you'll turn in, and the only thing you'll be able to present is that PowerPoint. So you can't go outside the presentation to actually present anything. But that will be next Monday. And again, that'll be group case 1, 10% of your semester grade. It'll be 6 10-minute presentations run right after each other. I will listen to you. I'll grade you in real time. You'll get a grade at the end of the class. And it'll be a group grade for your team. 1 team member needs to submit by 10 a.m. Monday morning, regardless of section. And even if you're not presenting, you need to still be here. Questions about group case 1? Hopefully pretty straightforward.
I'm sorry, did you say this was due on Wednesday or Monday?
So it was originally due on Wednesday. It's now due Monday, September 28th, 10 a.m. is when you need to turn in your PowerPoint. And then that day during class, some member or members of your team, I'll leave it up to you, will make a presentation for 10 minutes for a grade.
All right, thank you.
And even if you're not there presenting, you need to be there to support. And by the way, the presentation can involve Q&A. So I might ask your team a question. And so even if you're not presenting, your team members might be there to help you in the answer to the questions, right? Because I expect that over the next week that you know more about CVS by doing the EIC. You got 7 or 8 team members spending a week on this with Bloomberg. So for example, if you didn't know that they bought Aetna last year, that would be a big ding on your presentation. So just as an example. So again, I expect you to know some of the big things. I might ask you about some of the big things as we're talking about that company and that industry. So other questions about group case 1? Right. The other thing that you should have started today is your Bloomberg Trading Challenge. So by Friday / this morning, you should be into some positions and having at least 70% of the $1 million working. So you aren't at more than 30% or $300,000 in cash. So just logging into Bloomberg right now so I can share my screen, and let's get a sense of where we are as teams as of this first week of the competition. So back to logging in, sharing my screen. All right, so looking at Bloomberg, to get to the trading competition, it's either IDEA or TMSG for the team captains, whoever has access. Screen is being a little slow. IDEA. And this is section, I believe, 201. So these would be the teams. Now, first thing I would check is this is the column that you're going to be scored on. It's called portfolio value from highest to lowest. So of our teams, basically the good news is all of them, I don't count, are less than $300,000 of available cash. So you guys have all done at least the minimum amount of investment. Over the course of the first half of the semester, you need at least 10 longs. This is the column for the trades. So all but one team have already satisfied that requirement. Only one team is at least 3 trades short. And again, you're going to be scored here on portfolio value. Obviously, the markets are down. So right now, Kay Katoya, your team would be in first place by losing the least. After 1 week, markets are down, so you earn relatively less. So you would be in first place, although it's not by much. And again, you can see your portfolio value relative to the other teams. Now, when you log in as a team captain, you're going to see a bunch of X's for the team names. So you won't actually see the names of the people that are participating. You'll just see X's beside your own name. So I'll try and log in time by time every week and at least kind of give you a sense of where you stand. So you see where you stand relative, but again, specifically who the teams are that you're competing against. Questions about the trading challenge? And again, on Wednesday, when Bloomberg is here, they're going to be giving you some additional tools to help with that. Okay, so the other thing we were doing today is we want to talk about homework 3, was the Lockheed Martin assignment. So LMT, US equity. As part of that, for the EIC, you'd have started out with the E, which means you'd have gone to the RV screen. You'd have gone to the Markets tab, and then you'd have clicked on the Beta subtab. Now, I can't explain this, but for whatever reason, GICS, sub-industry, U.S. country domicile, I get 51 companies, right? Apparently, other people are getting a lot less companies. I can't replicate why you have less companies. But regardless, if you did this, you should have this amount of companies. What I told the TAs to do, as I said, look, if they did the right comp source, but they had fewer companies, to give you credit as long as you submitted it and talked about the data correctly throughout your assignment. Okay, so this one we will be a little bit more liberal of. You should at least be directionally correct from these numbers, but you might have slightly different numbers. And again, I can't explain why you have a different industry. The only thing I could think of that I mentioned was under global settings, whether under the list of comparables, you're, for some reason, we're restricted to a smaller list than 50, but 50 is the default. So this number shouldn't have changed for anybody when you logged in, unless you physically went and changed it. So again, back to this would have been the list, and these would have been the companies. So industry beta would have been 1.42, Lockheed Martin 0.98. So given this data, how would we have answered the E part of the EIC? What would you guys have said, or what did you say?
That it moves pretty consistently with the market, being like it's a very nominal difference between 0.98 and a beta of 1.
For Lockheed Martin.
For Lockheed Martin. And then the overall industry with a beta of 1.42, we can tell that for every 1% the market goes up or down, the overall industry would also go down by up or down by 42%. Showing that Lockheed market is less sensitive to economic activities than the overall industry average.
Okay. So again, I think as a minimal acceptable answer, what you said is probably good enough for the E section, the EIC. All right. So let's just talk about an interpretation of this. WEI. These are the markets today. They're awful. S&P's down 2%, Dow's down 3%, it's down 800 points, NASDAQ down 1.4%. Okay. What should have happened to the defense stocks? If the theory plays out, what should have happened to the defense stocks?
They should have gone down more than the S&P.
Yeah, that's what we would expect. What about Lockheed Martin?
Should have gone down less than the S&P, just barely.
Or about the amount of the S&P.
Yeah.
But they should also probably go down less than the average defense stock, right? So let's go back to this list. RV. Here is change today. This list down 3.6, Lockheed's actually down 4. Now, some of these are a little bit higher, but it shouldn't be a surprise. This industry is actually down more than the average. It is a little bit of a surprise that Lockheed Martin's down much more. Look into that. But the point is, this is what starts to correlate over time with the beta, right? Now, today, Lockheed Martin is an exception. But if you look at, for example, the last month, Lockheed Martin about the same as the industry, okay? More today. That's not what it's been historically. So obviously something's going on with Lockheed Martin that we probably want to look at, right? But just a high level. Now, part of the reason why Lockheed Martin is less sensitive, and again, just more insight for you as you start to understand these companies, is if you go to FA, which is historical statements, and you go to their segments of their business, Aero, which is planes, RMS, which is like helicopters, space, missiles, ISGS is like information warfare, counterterrorism, stuff like that. Scroll down here, or sorry, cybersecurity. Something unique to the defense aerospace business is, and they report this out by business, is something called order backlog. Okay. Last year, as of December 2019, they had $144 billion of order backlog, which basically meant contracted sales that haven't yet been delivered. Right? Their aeronautics business, which makes planes, has $56 billion worth of planes that have been sold that they haven't built yet, but they're already contracted for. So to put that into perspective, they got $144 billion worth of backlog, and last year they had $60 billion worth of revenue. So they have about 2.5 years worth of sales before they even start doing anything. Okay. This is one of the reasons why Lockheed Martin has a lower beta than their peers, because basically they have such a long backlog of order commitments. And you might think that that should actually drive the beta even lower. Part of the reason why it's not lower is the vagaries of the political process, which is even though you have a contract with the government still has to procure the funding every year through Congress to fund those orders. And if for some reason Congress changes, then some of those orders could actually fall into kind of a problem area. In fact, we're about to run through that at the end of this month, okay? Because Congress has to approve the Democrats and Republicans. They can't get together on anything. It's called a continuing resolution to keep the government going. And so if they don't approve that funding, then companies like Lockheed Martin can actually suffer because the government doesn't have money to pay them. So long story short, this is something that on the one hand is a benefit, but it's not as much of a benefit just because of the vagaries of the election system. But generally, this helps Lockheed Martin, and particularly a lower beta than its peers. Okay. Now, beyond that, we'll go to the I in the EIC. So RV, custom, spread. You should have had something that looked a little bit like this. Yeah, and your numbers, if you had a slightly different list, should be close to this. But this is an attractive industry, excuse me, because it has a positive spread. 8.2% WACC against a 12% ROIC. That's 4 points of positive spread. This makes it an attractive industry. Lockheed Martin with clear competitive advantage with a 43% ROIC against an 8% WACC. So this one should have been pretty straightforward. Now, I found in the last class that some people chose the wrong region and they did global by mistake. And if you do global, you actually end up with a negative spread. And the reason why you end up with a negative spread is because of Airbus. So Airbus, which is a European company that sells primarily commercial airliners, gets mixed in with the defense and aerospace industry for the United States. And so when you throw in the European Airbus commercial business, first of all, you don't understand the true spread of the defense and aerospace industry because you're putting apples and oranges together and you got the wrong assignment. But regardless, it also changes the industry spread from positive to negative. So that's why choosing your comp source matters. But again, for aerospace and defense, we probably wanted to use the US market because we're kind of tied to the US government. And that's the business that we're trying to understand for this assignment. So if you got a negative spread, it's because you chose the wrong comp source. So if you are in that situation, what I'll probably tell the TAs is take off some points for the wrong comp source, but as long as you consistently explained it to give you partial credit, right? But as long as you had the right spread positive with a slightly different list and you did US, then even if you had slightly different numbers, as long as you explained it correctly, you can get full credit, right? So questions about the numbers, what they mean, why this is an attractive industry. All right, now for the past the easy part. Next question. Why does this industry have a positive spread? 5 forces. What explains it?
One has been like a consistent increase in military spending and defense spending like throughout the world. And they've also, the American companies, especially Lockheed Martin, have been starting to get more deals in Asia and such.
Okay, so which of the forces would you relate that to?
I would say buying power of suppliers.
Okay, well, suppliers would be the suppliers to Lockheed Martin. So in this case,
Oh wait, yeah, no.
customers, I'd probably put in the buyer box. It'd be in the buyer box. Okay.
Okay.
But again, I think it's a legit trend for why they probably have a positive spread as an industry. What else? Why else is this an attractive industry in the five forces?
It's attractive because Lockheed Martin, for example, has very few suppliers. They have a ton of suppliers to go between, and they choose the most competitive prices for their products. And they also have the backlog in terms of who buys from the governments. The U.S. has like 3% of their budget every year is used for this, and part of NATO countries are required to have 2% of their budget used for defense, and they plan into the future. And these companies like Lockheed, Raytheon, Northrop, and Boeing all have long advanced products and are the most trusted ones. A lot of the governments don't go to many of these smaller ones that have worse spreads. The government using Boeing as a negative spread is because they have the commercial flights. Otherwise, if it was just the defense things, they'd be fine. And in terms, I'll think of others, but that's basically the grand scheme I believe in.
Okay, I would say I agree with your statements, but there's one important clarification I want to make. When you do the industry analysis, it's not about the company, it's about the industry. So when you say in the industry analysis that it's about Lockheed Martin, blah, 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 then what you're really doing is that should be in the C box as opposed to the I box. Okay, because industry analysis is about the industry that the company is in, which includes all the companies, as opposed to when you start talking individual company, then you're talking about competitive advantage box, your individual performance. So we just want to split those out when you make those determinations. But conceptually, okay. So just a few things to unpack there. So number one, this industry doesn't have a lot of rivalry. And part of the reason it doesn't have a lot of rivalry is it has high barriers to entry. Like it's hard to become a large scale government contractor, right? Especially with cleared workers, right? Because they're doing confidential work. A lot of what they do are black projects. So they can't even talk about this, and you need to have security cleared workers. So part of the point is it's really hard to get that security clearance as a company and for individual workers. So that tends to be a barrier to entry that helps the firms that are already in this business, and it keeps some people out. So it's not easy for Microsoft or Google to just walk in and say, hey, let's do a bunch of defense business, right? Second thing is that there's not a lot of substitutes for what they do as a result of this. It's harder to substitute military stuff for commercial stuff, right? Especially sensitive things. And so that also starts to involve political considerations as well, and generally tends to benefit the industry because it does keep them a little bit more insular versus some other products, at least today. And the rivalry is not as intense for one other reason, which is people generally stay in their lane, right? There's not a lot of people making fighter planes. And when Lockheed Martin wins the fighter plane contract for F-35, they're the only fighter planes that can be made for the next 10 years. So it's not like somebody else is going to pop up and say, oh, I'll give you a cheaper plane. Or the competition's over, and once the contract's awarded, the other supplier's out of business. So on the one hand, it led to more rivalry historically, but right now what ended up happening is each of the companies kind of have their own lane, and they kind of leave the other lanes alone. So if you want drones, there's a couple of companies you go to. If you want hypersonics, there's a couple of companies you go to. If you want certain types of planes, there's a couple of companies you go to. They don't really cross over, and they become more of an oligopoly, which has allowed them to make more money, and there's a lot less choice for the customer, also taking away some of the buyer power. But those are just some of the reasons why it's a very attractive business now, okay? Why is Lockheed Martin doing even better? Why do they have such a high competitive advantage? What distinguishes them from everybody else?
It might just be like what you just mentioned, how like the planes that they're making like one of the only stealth fighter jets or whatever.
Yep.
and they're like the sole producer of that plane for the next few years, as opposed to any other company having that contract. They're just the biggest company in defense right now.
Well, they're the sole producer of certain planes. They're the sole producer of the Black Hawk helicopters. They're the sole producers of, as you point out, certain types of things, and they have these big backlogs. So they're kind of like one of the biggest companies with a not much competition, with some of the highest price tag stuff that the military does for hardware, and they have exclusive rights to those for a long period of time. So for the next few years, they're probably going to continue to do extraordinarily well with their programs, right? And it's kind of almost like locked in business with that backlog, unless something dramatically changes, right? Now, what about the industry in 5 years? Is this industry going to still be as attractive in 5 years?
Yes.
Why?
Well, I still think the landscape for it, because as well as all this, there's been a lot more demand for just commercial and private jets like throughout the world as well. So that combined with the increase in defense demand, it's going to continue going, and also with the rate of how they catch up with their backlogs, they have at least like 10 years of backlogs left if they have no more orders that come in.
Well, it's more like 2 years, but yeah, they got a long backlog. The whole industry does. Okay. That's probably saying that, barriers to entry are still going to be high. Not going to see a big change in the number of big companies in the industry. You might even see some consolidation. There's not as much rivalry going forward generally. As long as the government doesn't assert power, they're probably okay. So is there a scenario that could hurt this industry in the next 5 years?
Yeah. So what I said was the power of buyer is extremely high because most of these companies are dependent on the U.S. government for their revenues. If, for example, the defense budget cuts down even a little, all these companies will be affected immediately. So that can reduce the spread, and that's what I argue.
Yeah. So about 7, 8 years ago, the word was sequestration, where what the government was doing was it was actually force cutting these budgets by 5-10% a year. And so basically, even though there's these long-term orders, the government said, look, we're spending less money, and there's just less money to go around, and the whole industry suffered because the buyers actually exhibited more power through sequestration and stopped spending money. And so that actually hurt the industry. Now, we've kind of gone beyond sequestration. Right now, we're in the other mode. We're in high spend mode. But you know what? In 45 days, we have an election. And who wins that election might have a view on how much we spend and what we're spending on going forward. So that will be the other thing. Politics starts to enter play, and whether we have a Republican administration or a Democrat administration might actually affect it a little bit more. I would probably argue a Democratic administration might put a little pressure on the spread. Not saying it's going negative, but probably a little less positive than if we had a Republican administration. And that might be part of the calculus as well, that there's some uncertainty on the business. So again, probably either same or lower, primarily driven by what's going on politics that's foreseeable now. Lockheed Martin, going to be insulated from some of that by their backlog, but still maintain a pretty hefty competitive advantage. All right, questions about homework 3. Types of things you need to talk about, things you need to understand.
So, Professor, I think I did the global region, and I had the negative spread for the market cap weight for the industry, and I think that would result in some different answers, but I feel like it is what I made out of the negative spread, so I'm not sure how exactly that would affect the grade.
Well, as I said, I'm going to talk to the TAs, and my sense is there'll be a slight penalty for having the wrong chart. You chose global, not the one I told you to choose. But that being said, as long as you can explain it. So here's how I would assume that you would have some differences. So because you have Airbus as a big driver here, that negative 35%, then what you really need to start doing is say, look, as I look at the companies on the list, a lot of these non-US companies have much lower returns, which suggests two things. One, Airbus is driving this. So the commercial business of Airbus is hurting this list. And that you have to explain that in terms of commercial aircraft. But the other thing is that the other governments aren't spending as much as the US is on defense. And their defense companies are not nearly as profitable as the US companies as a result. It's a more competitive market, and it's a smaller market, and it's essentially a less profitable market. And you need to be saying some things about that relative to the peers. So again, it depends on your peer group list as to how you interpret the industry, and then you have to interpret the industry based on the data that you see. And unfortunately, when you add in a couple of big negative companies in here between this list and this list, it really changes the view of the industry. Because you're putting in Airbus, a big negative, and you're putting in some much more average, lower European companies than would have been on this list. So you have to explain that why in some form or other to basically justify the numbers that you see.
All right. Thank you.
Sure. Other questions? All right, so for Monday, week from today, for your group project, you're going to be working on CVS, or what's actually known as CVS Health, CVS US Equity. And I think the E part of the EIC is relatively straightforward. I do want to tell you that the I is a little bit more complex for CVS than it was in the past two assignments, right? So RV, you're going to have to figure out what your RV is for CVS, either Bloomberg or analyst curated, etc., because it's a smaller list versus best fit, which is a bigger list. But here's the important thing. If you go to FA, because I'm not going to spend too much time here because you're going to do the analysis, but go to FA and you go to segments. I want you to understand that CVS is a $257 billion in revenue company last year. They're in the top 5 of companies in the world for sales, in the US for sales, based on their Fortune 5 company. So they're 5th largest company in the United States. And part of it is because last year they bought Aetna, the insurance company, is now part of CVS, and that's $69 billion worth of sales. Okay, so CVS is 3 businesses. One business is the CVS retail stores that you go into probably weekly, right? So those CVSs are $87 billion worth of sales. And in those retail stores /LTC is basically the long-term care clinics. So basically minute clinics. So the minute clinic where you go in to see your flu shot, your practitioner, whatever, that are in the CVS stores, which you buy your milk and your bread and toothpaste, that is the retail business, okay? $87 billion. They now also own a pharmacy business, $141 billion. These are prescriptions, either prescriptions from the CVS stores or prescriptions by mail order prescriptions, big business for them as well. And then the third business that they have is that they now own a health insurance company, insuring millions of Americans for health insurance policies. That's $69 billion worth of revenue. So the point is, when you get to the I in the EIC, it may not be so one size fits all for CVS, because the dynamics of the insurance business, Aetna and what's going on, might be different than the dynamics of what's happening with the pharmacy business, which might be different than the dynamics of the retail stores. So you might need to do a multifaceted industry analysis and say, the industry for pharmacy is this, the industry for retail is this, the industry for healthcare is this, and here's how they might differ. Now, you won't be able to very easily create spreads by industry because there's not a lot of clean companies that just do each of those. All the companies they compete with, like United Health Group, which is actually what started the trend, are integrated. And they have multiple segments. But what I'm telling you is when you get to the I, they might need to address some of the trends in the segments, which might be not the same across all businesses. So that's the only hint that I'll give you for CVS as you do your analysis for your I and your C. All right, still got 10 minutes for the presentation. You're doing it all in PowerPoint, group project. Questions about next week?
How difficult is it to make it so you can do retail stores and do pharmacy services stores within Bloomberg, like in terms of creating a list? Or because you said,
I'll give you a sense of this. So let me just go back here to key stats. RV. So let's say I want to do pharmacy services. All right. So I can go here to food and drug stores. Right. That's CVS, Walgreens, and Rite Aid. So I can get some sense of this, but the problem is there's not a lot of broken out individual stores, because you also got grocery stores and some other stores, corner stores, but this is the list. Versus if I do healthcare supply chain, these are people that compete with more of the pharmacy side, because these are the prescription drug companies that do prescription drugs in the back end, versus these are the insurance companies. So you can get some sense of this, but as I said, it's not a complete fair comparison, because CVS is all three combined, whereas Anthem, Cigna, and Humana, they don't own retail stores and they don't own pharmacy by mail. They're just insurers. So to some degree, it's just hard to do a pure play analysis because you're not looking at a pure play firm. And some of these companies aren't pure play. Like United Health Group is not a pure play firm. So this is mixing multiple businesses, whereas Cigna is pretty clean as just being an insurer. So just, you can kind of do it, but it's not so easy. But nonetheless, you'll figure it out. You guys are smart kids.
Professor, so for a CVS, do we have to do an industry analysis for each one of those segments?
I think you got my hint that you might need to at least think about that. Because if they're not all one size fits all and they have some differences, you need to talk about the differences.
Okay.
I don't think in 10 minutes you're going to have time to do full industry analysis in all three businesses. You'll run out of time. But you might have to highlight some of the differences.
All right.
Explain it. Some might be more attractive than others. You'll have to figure that out, and whether it's going to be changing over time. By the way, the analysts are talking about this. So if you're going to BRC, you're going to BICO, you're reading the IBIS World Report, they're dealing with this too. And you'll start to see some themes that come up. But that's as many hints as I'm going to give you right now. All right, other questions? All right, so the final thing I want to talk about today is lecture note 3. Which I posted on Elms. I'll bring up the PowerPoint. All right, so share this. All right, so once we finish the EIC next Monday, we're going to go into the second section of the class, which is going to be on historical analysis. Right? And as I like to say, you can't drive a car, look in the rearview mirror, but the past doesn't guarantee the future, but the past helps you understand what the future could be based on where you've been. And the other piece of the historical analysis is going to set up how we do valuation. So what's core to a lot of what we're about to do in this class is what's called the Modigliani-Miller or M&M model of valuation. And that is represented by this graphic on the right-hand side of this slide. So the idea is a company is worth the sum of its future cash flows, present value to today, discounted. But what we're going to do is we're going to break those future cash flows into two buckets. One of the buckets is going to be called operating cash flows, which is basically the cash you get from selling products and services day to day. And the other bucket's going to be the present value of the non-operating cash flows, which have nothing to do with sales, but other things that you earn money on. Okay. So when you add those two together, you get something called the enterprise value, or EV, of a business. And is that enterprise value, that's the cash available to pay the operating and non-operating activities, that is available to pay the debt and the equity holders, your stakeholders. So since debt gets paid back first, enterprise value pays off the debt first. Whatever cash is left after the debt holders have been paid belongs to the shareholders. That's the equity value. As a matter of fact, divide by shares, share price. That's what's known as the enterprise discounted cash flow, or enterprise DCF valuation method. It's actually very straightforward, and that's the process that we're going to use in this class to value companies. Okay, so this is Modigliani Miller, straightforward methodology. The problem is we have to convert financial statements, income statements, and balance sheets into the Modigliani Miller methodology. And that's the part of the class that you're going to struggle with. So I just warn you, this is the hardest part of what we do. And the reason it's hard is just because it's non-familiar, right? Because in every other class that you've taken up to this one, and in the real world, they don't do this either. It's McKinsey's approach. Basically, you do what I call the direct valuation process. What I mean by that is you start with income statements and balance sheets, and you directly forecast the cash flows that you value. In this class, we're adding an incremental step. We're going to take these income statement and balance sheets and rearrange them and remap them into economic statements that are mapped to Modigliani Miller. So we're going to put them in this 4-box format. Okay? And using this 4-box format, we're then going to create the cash flows. Income statement minus change in balance sheet is cash flow. And then using the cash flows, we're going to forecast them to create the operating, non-operating forecasted value and enterprise value of the companies. Okay? So we're going to do this intermediate step of converting financial statements to this economic format, which is a McKinsey format that generally doesn't exist elsewhere. And you're going to have to learn how to do that. It's an extra step that no one else does. The advantage of doing this extra step is twofold. Number one, it's more work up front, but it makes the analytics cleaner, and it makes it much more straightforward about what's going on. Advantage number two is it makes the valuations easier, because everything is put into the proper place to do the valuation. You really know what's going on. So it's more work up front, but it helps us on the back end when we do the valuation, and particularly our understanding of the companies. So that's what we're about to get into in the second section of the class. And that's what's going to be on your midterm exam. In fact, your entire midterm exam is on converted statements. And that's going to be the second group project, where you're going to have to convert statements in the company and explain and analyze them historically. By the way, the third part of the class is going to be taking these converted statements and forecasting valuations. So this is kind of core to what we do. And this is going to be an important part of the next steps of the class, to understand this language. So to help you with that process, I developed some mnemonics, because I used to have to do this at the McKinsey Analyst Training Program. And I realized I had to take non-financial people and very quickly teach them how to do what we're doing. And it's not easy to begin with, much less people have never taken a finance class. So one of the things I found that was useful, so if the process that I'm about to show you, you talk about anywhere else, people are going to look at you like you're crazy, right? But the idea is to help me understand and to help you understand this, what we're going to do is we're going to label each of these Modigliani Miller boxes. So the operating cash flow box in this class, we're going to start calling box 1. The box 1 cash flows, the operating cash flows. In this class, we're going to call the non-operating cash flows box 2. So that if you add 1 and 2 together, you get enterprise value. or EV, EV for short. So operating plus non-operating cash flow equals enterprise value, 1 plus 2 enterprise value. Or that is also equal to the debt cash flows, cash for the interest-bearing debt, plus the equity cash flows, 3 plus 4. 3 is the debt cash flow, 4 is the equity cash flow. So 1 plus 2 equals 3 plus 4 in this class. In fact, 1 plus 2 minus 3 equals 4. That's enterprise DCF, right? So it's just a way to help us keep track of what's happening with each one of these Modigliani-Miller buckets. So here's what's going to happen conceptually. We are going to start with the income statement and the balance sheet. It doesn't matter which statement we start with first. We have to convert them both. So we'll start with the income statement. Convert the income statement. So what we're going to do is, if you've ever taken a Lego toy and you rip it apart and you put it back together, when you put it back together, all the Legos have to be accounted for. You can't actually leave a Lego on the floor to do this right. So essentially, when we reconvert the statements, everything's going to be accounted for and everything will still add up. Will still foot. Okay. So the income statement, what we're going to do is we're going to take every line item in the income statement and we're going to label it operating 1, or non-operating cash flow 2, debt equivalent cash flow 3, or equity equivalent cash flow 4. We're going to take all the operating items from the income statement, we're going to put them in the first box, and that's called the operating box, and that's going to get us our no plat. We're then going to take the non-operating items on the income statement, we're going to put them all into this box, and that's going to get us our non-operating income. And if we add the no plat and the non-operating income together, we get something new called TII, total income available to investors. And it is this income that can be distributed to the debt and equity investors. So we'll then take all of the debt payments on the income statement, the interest expense, and all of the equity payments on the income statement, the net income. We'll add that together, and that will also equal the TII. So we'll have the profits that we earn, the non-operating items that we earn, all told are the payouts to the debt and the equity holders. That's Modigliani-Miller. We're going to do the same thing with the balance sheet. We're going to take all of the operating assets and operating liabilities, we're going to net them, invested capital. That's the operating cash flow on the balance sheet. We're going to take the non-operating assets and non-operating liabilities, non-operating capital. Add operating and non-operating capital, something called total funds invested, TFI. And that's going to equal all of the interest-bearing debt on the balance sheet, all of the equity on the balance sheet. 1 plus 2, operating plus non-operating, 3 plus 4, debt plus equity. Once we've rearranged these two statements, we will create statement number 3, income statement rearranged, balance sheet number arranged. We then create cash flow. Cash flow is income statement minus change in the balance sheet. Operating cash flow, no plat, change in balance sheet, change in invested capital, it's called free cash flow. That is the operating cash flow of the business. Non-operating income minus change in non-operating investments, non-operating cash flow of the business. Add the operating free cash flow to the non-operating cash flow, we'll get something called CFI, cash flow available to investors. We could have also forecasted CFI by forecasting TII minus change in TFI. So we're going to start to learn that we can go across, we can go down. And by the way, cash flow to investors is the cash that we can pay out to the debt holders and the cash that we can pay out to the equity holders. The cash that we pay out to the debt holders is the interest expense from the income statement, change in debt from the balance sheet. Dividends, change in equity, cash flow to equity holders. CFI, cash to debt and equity holders. So again, we're going to create the cash flows. We're then going to forecast the cash flows. The forecasted cash flow, free cash flow, is our operating value. the forecasted non-operating cash flows, non-operating value. Add them up, enterprise value. Enterprise value is the cash available to the debt and the equity holders. Modigliani-Miller valuation. That's the process that we're about to go through. There's a chapter in the book which will be very helpful if you read as we go through this. And next week, there will be a video as well talking through how to convert, and then homework 5 coming up soon will be your first conversion assignment where you'll be starting to convert income statements and balance sheets into this format. Okay, so I want to give you context about why this is an important step in looking at a business and how this is different than what you do elsewhere. And a good way to see this is on the next slide. I like to call this the two views of ROIC. On the left is what we call traditional ROIC, also known as Bloomberg ROIC. On the right is operating ROIC, or we'll call McKinsey ROIC. This is what you're taught on the left-hand side of the screen in the academic classrooms, and this is what Bloomberg does in the real world. So when you did your homework assignments, this is the ROIC Bloomberg gave you on the left-hand side of the screen. And conceptually, the idea is profits after tax divided by investment, return on investment, and they define investment as total assets minus non-interest-bearing liabilities gets us interest-bearing liabilities and equity. This is the long-term financing of a business. Profit divided by the long-term financing of a business equals all the assets minus the non-interest-bearing liabilities. So the idea is when they talk about return on investment, they're basically saying, what's the return on the long-term investment in the business, the debt and the equity, interest-bearing debt and equity. That's the standard definition, which equals all the assets minus the non-interest-bearing liabilities. The challenge with this is that this is an average. And what I mean by this is that some of these assets are operating and some of these assets are non-operating. And in the traditional definition that Bloomberg uses, they're intermingled. Operating assets are basically the revenue and the assets that you use to sell products and services. Non-operating assets are things that have nothing to do with sales that still have value, but have no change in the business value that's tied to sales. So the point is, when most people do valuation and they forecast the assets, because they forecast them together, they're doing an average of the two. And if the business doesn't go up at the same rate, if the operating assets and the non-operating values don't go up at the same rate, then it will cause a mistake in the valuation. So what we're going to do by breaking into Modigliani-Miller is we're going to forecast an operating return on investment and a non-operating return on investment, which will equal the average return on investment. So let me show you how this applies in practice. I'm going to go back to Bloomberg. And I'm going to reshare the screen. All right, so let's say we go to Apple Computer, for example, most valuable company in the world. Here's Apple. And I'm going to go to Value Apple. So by looking at their FA, what I want to show you is one of the challenges with Apple, this is 2019, is they had $260 billion worth of sales. They had almost $76 billion of EBITDA. That's the profit after tax, approximately, proxy, right? But the problem is the investment. I divide this by the balance sheet of Apple, right? The debt and the equity. So I come over here and I divide it by the balance sheet of Apple. So I look at their debt and I see total debt, short-term borrowings of 16 billion. I see long-term debt of 105 billion. And then I see equity of 90 billion. Okay, and I add it all up and I get my investment. So I take my after-tax profit and I divide by that investment. Then I get RV custom something called return on invested capital. And that tells me that Apple's return on invested capital last year was about 29%. Okay, so take their after-tax profit, EBIT after tax, I divide by total investment, debt and equity, and I get around 29%. So we know from a previous module and reading in the book that that means that they're generating 29 cents of cash for every dollar of investment of after-tax profit. So I forecast Apple, and I forecast 29 cents of ROIC at some growth rate, and I discount it at the 8.18% WACC. I don't get 1.8 trillion. Matter of fact, I have a hard time getting to 1.8 trillion doing this. The reason I have a hard time doing this is because the assumption here at a 29%, I'm rounding off ROIC, is that the next dollar of investment will generate 29 cents in profit. Okay, that's the assumption I'm actually building into my valuation model. Spend a dollar, make 29 cents. Spend a dollar, make 29 cents. Keep doing that, make 29 cents. Okay, so translation, spend a dollar to sell an iPhone, make 29 cents. Spend a dollar to make an iWatch, 29 cents. But that's actually not what's happening, because Apple has, you can see this on their balance sheet, FA, $206 billion of cash sitting on their balance sheet, doing nothing except earning a little bit of interest, almost sinking the island of Ireland, because basically they got a lot of cash, but they don't actually need that cash to sell the next iPhone. So when you do 28%, what you're implicitly saying is Apple needs to borrow another $200 billion worth of cash to sell the next $260 billion worth of product. That doesn't make any sense. They're not going to borrow all the money just to have that much cash on hand to sell that many more iPhones. They don't have to do that. So Apple is not going to borrow the $206 billion. They're going to borrow what's left after the $206 billion. So here's the deal. Apple actually buys the iPhone from a company called Foxconn. Foxconn is a Chinese company that's going to sell Apple an iPhone for about $400. Foxconn has hundreds of thousands of workers and billions of dollars worth of factories sitting in China that makes watches and phones and everything else on Apple's behalf. Apple's going to buy that phone from them for $400, and they're going to sell it to you for $1,400. And they're going to pocket $1,000 of profit. And they didn't really make the investment. Foxconn made all the investment. So on virtually no investment, they made $1,000. So what I'm telling you is if you actually look at the operating return on investment, which is how much Apple's actually spending on investment relative to the profit that they make, or the real ROI on their phone business, that's called operating ROIC. And last year, Apple's operating ROIC, which is broken out, because operating ROIC plus non-operating ROIC equals Bloomberg ROIC, which is the average of the two. Their operating ROIC was, drum roll please, 350%. So let me say it a different way. When Apple sells a computer, a phone, a watch, an iPad, for every dollar of investment, they're making $3.50 in cash profit. They're not making 28 cents. They're making 350. So that's why Apple's so valuable, because to some degree, the Bloomberg ROIC distorts their true value and it underrepresents the value of Apple, because they're a lot more profitable than they look, because this includes $200 billion worth of cash. And if you strip out the non-operating assets, which have nothing to do with Apple's value, then it's $349. So said another way, Apple's value is 209 billion or 206 billion or whatever their cash balance is of non-operating value. So call that 200 billion, and 1.6 trillion of operating value based on the 349% ROIC. So the real challenge with traditional modeling that people do, and Bloomberg does this by default, is this number that we've been doing everything on is an average. It's an average of the entire business. So don't get me wrong, it's the real average of the company. But the problem is when you start forecasting, you're forecasting based on the average and you're assuming that the operating and non-operating grow at the same rate. And they don't. And in Apple's case, it won't, because they got so much cash on hand, Google being the same thing. And so when the operating and non-operating ROICs are different, then the valuations will diverge from the average. So what you're going to see for Apple is operating ROIC 350%, non-operating ROIC 1%, weighted average of the two 29%, something like that. And so long story short, that's what we're going to start getting into when we do the valuation that we'll get insight on by doing the economic statement conversions. I've been on a long monologue on this. I'm going to pause here and just see if that makes any sense. Questions?
I have a question. So what happens like when a company, like, for example, buys equipment or maybe like drops a department or something, or buys and sells something that like doesn't really contribute to the operating like core of like their business functions? Does this contribute to the same issue that you're seeing, like with the difference between the operating and the non-operating ROIC?
Yes. Well, here's a real example, which is a few years ago. I think I could still see this in Bloomberg. Share. Go to Bloomberg. I was working with a company, TAP, called Molson Coors, the beer company. And this is one of the highlights. And so the problem they were having at the time, so I'm going to add in a field, add a column, is ROIC from a customized period. And I'm going to go years ago, 4. Okay. So what was happening at the time is their ROIC 4 years ago was about 4%, and their spread was pretty close to 0. And it looked like the company was doing poorly. But the problem was that they really were doing poorly. But the reason they were doing poorly was not because their beer business was actually doing poorly. The operating ROIC in their beer business was like 14%. Okay, so the beer business was actually doing really well. The problem was they did this multi-$100 billion joint venture with SAB Miller, which was a black sucking hole of cash. And so essentially, all the profits they were making in their beer business were getting wiped out by this joint venture. So the business looked horrible. Okay, but here's the thing: Molson Coors, if you looked at them, you're like, oh, this is a terrible company. And the answer is no, it's actually not a bad company. It's just they made a terrible joint venture decision. So the strategy for the business wouldn't be fire all the workers. You're a bunch of idiots. The strategy should be get out of the joint venture, all right? Because basically that's why you're in so much trouble. And that's what they ended up doing. So what I'm saying is you would misunderstand them as an analyst if you just use Bloomberg ROIC, because on a very superficial level, you're like, oh, here's a business that's not doing well. But if they're actually focusing on selling beer and they stop doing stupid things with the joint venture, then the business is actually going to start doing much better over time. If I don't recognize that and I just assume that the business is going to keep spending money in the joint venture, maybe they could, they keep making 4%, then I'm going to get two different answers for my valuation. So for some companies, there's not much of a difference between operating and non-operating because they don't have a lot of non-operating assets. For other companies that have a lot of non-operating assets, there can be a difference. And our understanding of what that difference is and how we forecast it has a big impact on how we value those companies. That's what we're going to start to focus on and get a little bit more granular. And that will make you a better analyst. And that's the approach we're going to start taking in this class.
Thank you.
Sure. Other questions?
So they were just losing money through a venture that, through like the joint venture the entire time. Why? I don't understand how it didn't like show up if they were like just bleeding money so much.
Well, because it's just the nature of the financial statements. So what happens is on a joint venture, you're going to have a big balance sheet item for the amount you spend on the joint venture. And then you're going to have the profits or loss from the joint venture, your share of those profits on the income statement, but it's a below the line number, meaning it doesn't show up as part of your operating profits. It actually shows up below your operating profits before you get to your net income, the share of the profits from the joint venture. So what's happening is their net income looked terrible because the joint venture wasn't performing well and they had hundreds of millions of dollars tied up in the joint venture and the ROI for the company looked terrible. But what I'm telling you is if you just separated the joint venture out, you took $300 million out of their balance sheet and you took the losses from the joint venture out of their income statement, the beer business was actually doing pretty well. So you took a business doing well and a business doing poorly and you smashed them together and you got a business that looks terrible. And don't get me wrong, as the owners of Molson Coors, I own the terrible business. But before I go out and I try and shoot the bad business, I might shoot the wrong business because I might actually say, kill the beer business, but I'm actually killing a business making 14% as opposed to kill the joint venture, which is the business that's actually killing the entire company. And so what I'm saying is a naive person would just throw the baby out with the bathwater and just say, oh, this is a terrible business. They're making 4%. Let's get out of here, right? And they just struggle. But I'm telling you, I'm not saying they made a stupid decision with the joint venture. It was a terrible decision with the joint venture, right? But the flip side is that's fixable. And the underlying business is actually still healthy at the time. Now, then people stop drinking beer, right? You can't get away from the EIC that people your age don't like beer anymore, right? Not as a high percentage of drinks. You're drinking hard alcohol. You're now smoking marijuana, although it's illegal in the state of Maryland unless you're doing it for medicinal purposes. But the point is you're moving away from beer and the industry is now in trouble. So this is a different situation than it was 5 years ago, but that's a different circumstance than just investing in a beer business that you made an overall poor decision. Got to understand this, and we're going to have more insight into what's going on in the business. Make sense?
Awesome. Yeah. Thank you. Appreciate it.
All right. So this is a preview. So I'm trying to just give you a roadmap about why you're going to hate me, because there's a benefit that you're going to like when you finally see statements in this format, but you're going to hate it because converting this format it's like learning a new language. You're going to have to suffer through this for the next couple of weeks to learn this new language because it's not standard. It's not the way it's standardly taught. But the good news is when you learn the language, things are going to make a lot more sense. So we just got to all struggle through this together. And that's the next section of the class that's coming up. So my recommendation is between now and next week, stick up with the book. Because again, there's a chapter on this which will introduce this in more detail. After you do your group projects, this is going to be homework 6, which we're going to start on the conversions of the statements next week. And then again, just coming up fast. Midterm's not going to be around the corner as well, coming up very fast in October. All right, last questions for today.
So would you say the best way to practice these concepts would be just to focus on the book and read the chapters?
I would say just read the book just because it's like learning a language. The more you can familiarize yourself by understanding the terms coming in, the better. But don't worry, you're going to have a lot of practice. You're going to have at least 2 homework assignments and a group project coming up, all converting statements. So I'm going to throw you right into the pool. I'm just letting you know I'm going to throw you into the pool. It's coming up. So any prep you can do will help you in the process.
Okay. I also saw that next week there's also like a homework 4 due, but there wasn't any content on it.
Yeah, so homework 4 is going to be based on Wednesday's Bloomberg lecture to us. Mm-hmm. I'm going to take one of the cool things they show us how to do and have you do it for homework 4.
Okay.
So I don't know what homework 4 is going to be until Bloomberg shows up, but they're going to show up some cool things. And just as a preview, I'll just tell you, like they gave me, see if I can find it, a new cool screen in Bloomberg that they're going to show us. Find it. Write it down. Notes all over my desk. Here it is. So just an example. So if you go to, it's depressing, totally depressing, but something that's real world, it's actually affecting what's happening in the markets today. So here is an example. Share screen, back to Bloomberg, CVID, brand new dashboard in Bloomberg. It's their COVID mapping dashboard. So summarized maps, which you can customize for COVID cases all over the world that you can drill down on. And so if you want to see the real data that's coming out of Hopkins, not the politicized data that's now coming from the US government, and for example, you want to turn this into a map and you want to look at any map in the world and start drilling down on it and start putting overlays on it, it's all virtualized and visualized what's happening to COVID around the world. And by the way, when you play around with this, completely depressing. Okay, but regardless, this is actually something that they've launched recently that's being used by Wall Street because it's helping Wall Street kind of visualize what's happening with the virus, whether it's getting bad or worse, where it's getting bad, what are the trends, and it's now starting to have economic impact. And you can see that in what's happened in the last couple of weeks in terms of the falls of the marketplace. So long story short, these are the types of things they're going to start showing us. So as part of our advanced training, I might see one of these things, have you do an assignment on this. But if anybody is interested in playing around with the visual mapping of COVID, CVID is the short code within Bloomberg. But they got lots of tips and tricks for us. That'll be Wednesday's class. Right? I'm going to stop the recording. I'm going to end the class here, give you the rest of the day back, and I will see everybody on